As part of the due diligence when acquiring a company, buyers sometimes hire a third party to conduct a quality of earnings analysis. More recently, it's also becoming common for the seller to hire a company to perform a quality of earnings analysis. If you're buying or investing, it's called a buy-side quality of earnings report. If you're selling your business, it's called a sell-side quality of earnings report. So why would a seller want a quality of earnings report, particularly if the buyer is going to get one anyways? There are several reasons: to increase the purchase price, to increase the chance the deal closes, and to reduce the risk of litigation. Let's start with the purchase price. If the seller gets a quality of earnings report that shows that it has clean accounting and no problems, this will reduce uncertainty among potential buyers. Less uncertainty means more bidders, and more bidders means a higher purchase price. Also, remember that the main purpose of a quality of earnings report is to adjust the seller's EBITDA. But do you think the buy-side due diligence team is going to be arguing for lots of adjustments to increase the seller's EBITDA? No, that would just cause the buyer to have to pay more money for the seller. A sell-side quality of earnings team can thus argue for upward adjustments to the seller's EBITDA where they're appropriate. Next, let's talk about the deal closing. A sell-side quality of earnings analysis can identify any potential accounting problems so they can be ironed out before the seller starts shopping itself to buyers. The last thing you want is for the deal to fall apart during the due diligence phase because the buyer finds out that the seller's EBITDA has been significantly overstated. A sell-side quality of earnings report will also reduce the amount of time it takes for the deal to close because the seller will already have all the contracts and other documents in place when the buyer goes to do its quality of earnings report. The selling company's management will also be prepared for the buy-side quality of earnings report because they'll have already gone through the process once before. The buy-side quality of earnings report will thus go more quickly and the deal can close faster. Finally, let's discuss litigation. A sell-side quality of earnings team can help with negotiations and drafting the purchase agreement. Lawsuits sometimes occur after a deal if there's a disagreement about how much working capital that the selling company actually needed. The sell-side quality of earnings team can help the selling company's legal team in drafting an ironclad purchase agreement that's very clear and avoids legal issues going forward.